Hello, welcome back to this week's market update. Today is Monday, November 4th, 2024, the day ahead of Election Day, and we had a very busy week last week, so we will jump right in. It was a volatile week for the markets, with stocks ending in negative territory ahead of the election amidst a flood of economic data and earnings reports last week as well. As of Friday, November 1st, we saw the Nasdaq Composite down 1.76% on the week, the S&P 500 not far behind, down about 1.63%, the Dow Jones Industrial Average also down about 0.8%, followed by the Barclays Aggregate Bond Index down about 0.7% last week. Heading into this week's economic data, the October jobs report showed the slowest job creation pace since 2020, with the U.S. economy adding only 12,000 new jobs in the month, much below expectations. Despite this, we did see the unemployment rate stay stable at 4.1%, so that is a positive there. By industry, we saw employment gains in healthcare, government, and wholesale trade, while job losses came from professional and business services as well as manufacturing, with the manufacturing sector being heavily impacted by strikes in companies like Boeing. Average hourly earnings were up 0.4% in the month and 4% year over year, so we are seeing some real earnings growth on that front. But overall, this is another month of the slowdown, especially with the slower month of job gains here. We also got the PCE inflation numbers for the month of September last week. Headline PCE came in at a cool 2.1%, while core PCE was a little bit higher at 2.7%. Nonetheless, both making quite a bit of progress from the peak in 2022. And even on this headline number, we are getting really close to the Fed's 2% target. So that is quite an improvement in that category. And then by the industry, services continues to be the primary source of inflation. That was up 0.3% in the month, while goods prices overall saw a decline of negative 0.1% in the month of September, which is the fourth decrease in prices in the past 5 months for total goods prices. Overall, seeing a lot of improvement, and it is definitely working towards the Fed's 2% target and is supportive of a possible rate cut this week in the November Fed meeting. Along with the PCE inflation report, we also got personal income, spending, and saving data for the month of September. It showed a 0.3% increase in personal income in the month. However, personal spending rose a faster 0.5% in the month, leading to a drop in the personal savings rate to 4.6% in September. So overall, this shows stability in consumer income and spending. However, there is a bit of a slowdown compared to maybe a year ago, but again, not in a recession. So we are teetering in between the growth and recessionary phases of the economic cycle. Another important data point from last week, we got the first estimate of third quarter GDP, showing that the US economy grew at a rate of 2.8% real GDP growth. So this is after the effect of inflation. So a pretty strong growth rate in the third quarter, at least according to this first estimate. By category, this was driven higher by consumer spending, exports, and government spending, while on the other hand, imports, which reduced GDP, saw an increase, which ultimately led to a slightly lower GDP than if imports had decreased. As one of the last few economic indicators before Election Day and the Fed meeting this week, this strong, stable growth suggests that the US economy remains stable with no signs of a recession, but not in a super expansionary cycle either. Another data point from last week, we got the ISM Manufacturing Index. It showed the US manufacturing sector contracting for the 7th month in a row and the 23rd contraction over the last 24 months. The manufacturing PMI dropped to just 46.5 in October, which is down quite a bit from September's 47.2. And it's also the lowest reading of 2024 and the weakest reading since July of 2023. So some serious weakness in the month of October in the manufacturing sector, but a lot of this has to do with union strikes and just overall business conditions, higher interest rates, and slightly higher inflation in manufacturing input costs. Overall, a continuation of the trend that we've been seeing, essentially a slowdown in the manufacturing sector. Last but not least, we saw a unexpected jump in consumer confidence in the month of October. You can see this right here. We've had a few other jumps you can see right here and right here. However, those were over a period of 2 months. This one was actually the strongest single month gain since March of 2021. The rise in consumer confidence was pretty broad-based with improvements across all age groups, with age 35 to 54 showing the sharpest increase in confidence. Overall, this is a positive indicator for the economy. A little bit confusing right ahead of an election month as we wait to see which candidate wins, but it is a positive sign for the economy that consumers are feeling more positive than they did a month ago. Looking ahead to this upcoming week, we have both the election as well as a Fed meeting, so expect some possible volatility ahead. We will definitely be closely tracking the news and markets this week as we have quite a bit of updates to cover, and we look forward to providing these updates to you next Monday. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.